In the last video, we had learned the modern approach to rules and debit and credit, and now in this video, we are going to learn the traditional approach to rules of debit and credit, and this is also called the golden rules of accountancy. As per this rule, an account or the accounts are divided into three parts. First, let me tell you what an account is. An account is a place where similar transactions are recorded and summarized. So here it is a place where similar transactions are recorded and summarized. So an account is a place where similar transactions are recorded and summarized, and based on some criteria they have been classified into three types. So under the golden rules, accounts have been classified into three types. The first one is the real account. And this deals with, the real accounts are those accounts which deal with assets and liabilities. Now moving on, now let's move to the nominal accounts. Nominal accounts are the accounts which deal with incomes, gains, expenses and losses. So the nominal account deals with incomes, gains, expenses and losses. So all the accounts related to incomes, gains, expenses and losses are classified under this head, which is the nominal head. Now moving on to personal account. Personal accounts are those accounts which are represented by a person. Personal accounts are those accounts which are represented by a person. So you can have Mr. A's account in your books. Mr. A can be a debtor or a creditor. So since he is a person, the account maintained in your books for recording transactions undertaken with Mr. A, who is a person, will be called the personal account, or rather will be classified under the personal account category. Now let us see some example of accounts which fall under all of these three categories, and we start with the real account. For example, under real account, we could have, for assets, we could have, say, buildings, say, plant or machinery, say, stock and cash. And for liabilities, we can have loans, we can have capital. Capital is also a liability which is invested by the owner of the business, and from the point of view of the business, capital is a liability, etc. For nominal accounts, the examples can be, for expenses, we can have examples like wages, we can have salaries, we can have rent, etc., etc. For losses, we can have a loss due to a fire or some abnormal event. For incomes, we can have sales, and for expenses, we can have purchases also. I missed to write that. For incomes, we can have sales, we can have say discount received, and etc., etc. There are many other incomes which I cannot write down everyone over here. And for personal account, I had said that this account, the personal head, carries all accounts which represent any person with which the business deals with. So say Mr. A is a debtor and the business deals with the Mr. A, so the business sells goods to Mr. A, so Mr. A's account would be a personal account. The person here in the personal account does not only include real men and human beings, it can also include a legal person. Legal person means a company. It can be a company which is a person in the eyes of law. It can be a firm, as in a partnership firm. It can be an association of persons, or it can be an institution, like the bank is also a person. So these accounts would come under the personal account category head. So now let us see what are the rules really for each of these categories of accounts. For real accounts, and under the asset category, for assets, we are actually seeing the rules. So let me write the word rules over here. Rules for debit and credit. For assets, the rule is you debit what comes in. Debit what comes in and credit what goes out. Credit what goes out. And for liabilities, the rule is just the opposite. For liability, the rule is just the opposite. It is a credit for what comes in it is a debit for what goes out. So basically, by what comes in, we mean an increase in the value of an asset. If an asset comes in, the value of an asset will actually increase. The value of an asset will actually increase and it will be debited. And by the phrase what goes out, we mean a decrease in the value of an asset. And if an asset goes out, naturally the value in your books for that asset will decrease, and so we are going to credit the asset account. Similarly, for liabilities, we have just the opposite treatment. If a new liability comes in or the value of liability goes up, we have to credit the same. And if the value of a liability comes down or the liability goes out from your business, then we have to debit the liability account. Now let us see the rules for nominal accounts. This is pretty simple. You don't have to see those increases and decreases in value. For nominal accounts, it is very simple. The rules are all expenses and losses are debited. All expenses and losses are debited, and all incomes and gains are credited. So you sort of need to memorize these rules in order to remember it in an effective way. Let me first discuss the rules for the personal account also, then I'll tell you about these aspects. So for expenses and for nominal accounts, all expenses and losses are always debited. All accounts related to the expenses and losses are debited, and all accounts related to the incomes and gains are credited. This is the general rule. There is no exception to this rule. And for the personal account, we have persons over here with whom we transact, and in a transaction we either receive something or we give something. So here we will debit the receiver's account, the receiver, and we will credit the giver. The account of the person who is giving you something will be credited, and the account of the person who is receiving something will be debited. You kind of need to memorize these rules. Because it will help you to journalize transactions in an effective way. If you don't remember the rules, you will not be able to journalize the transactions.